In 2022, Terra Luna collapsed and billions left crypto overnight. Most builders walked away. Arnold Lee asked one question: if this technology has a point, what is it? He found Bitcoin in middle school, traded it for gift cards, and then years later built Sphere Labs, a stablecoin infrastructure moving billions across borders, invisible to the people using it. Today we unpack that answer with Dr. Jemma Green on Unblocked.
Arnold, it's great to have you on Unblocked. Thank you so much for joining us.
Thank you for having me. It's great to be here.
You've discovered Bitcoin, I think, around 2009 when you were in college. Most people who discovered Bitcoin that early either become like maximalists or they drift away entirely. You didn't do either of those things. What happened in between, and what are you working on now?
Yeah. So in 2009, I think I was a target user of Bitcoin. Insofar, I was actually in middle school and I didn't have a bank account. And so while I was in the United States, I was technically unbanked. And my parents refused to open up a bank account for me. I think I was 13 or something. And so Bitcoin was a really convenient way for me as a young person to try and make money. I credit my much smarter younger brother, Eugene, for finding this on an early iPhone. But back then, it was unclear what custody even was. You would go onto websites and they would probably just issue you what is effectively a custodial wallet. But it felt magical because you had monetary value embedded in a site where you didn't need a bank account. You didn't need to be 18. It was much easier for us to use in comparison to something like PayPal. And so for, young kids, it was a way for us to save money to buy video games. But throughout the years, I feel like for most, it's a realization maybe that convictions about the banking system or about the monetary system or about, the way that money movement works are all, or there's an alternative possible. And these types of higher level realizations would come for both me and, my little brother, my circle at the time, much later down the road. In the early days, we were just users. We would, use Bitcoin as a way to buy things. And it was much more convenient compared to try and convince a bank to give an account to a 13, 14-year-old, or to try and convince our parents to buy us video games. And so I think we stayed in touch with the ecosystem insofar as we were users, but we weren't like active parts of, the Twitter community or the Reddit community or whatever other internet communities there were at the time. It was just a very useful way for us to actually use money. And it became a good memory, I suppose, or good core carving of the brain 10 years or so later when some of those higher level ideas became more relevant. How, this could be an alternative to banking or to money movement or, peer-to-peer settlement. But I think it gets a little bit easier to understand some of those concepts when you've had years of using Bitcoin and later, the other types of digital assets that would come about, Ethereum, Solana.
Back then, what could you actually pay for using Bitcoin?
Yeah, whatever you could convince someone else to give you in exchange for Bitcoin.
So rather than like shops or businesses, individuals that you were buying things from, that you could persuade them to accept Bitcoin as payment from you instead of cash?
Yeah, in 2009, maybe to like 2011, for us, it was pretty concentrated in a couple of sites that were effectively offering mechanical Turk-like services where you could like fill out surveys, you could take like actions on the internet. And so, we were answering forms like how many times do you drive your Nissan a week? Or like how many times do you exercise a week? I don't know if you remember, there was this really famous website back in the 2000s where you could like click on a button to donate rice internationally, but it was like a mini game almost. And so for those first 2 years, our activity was concentrated in this bespoke set of websites where you could do these tasks and they would give you Bitcoin in exchange. And if you earned enough Bitcoin, you could swap it in for like a gift card or for PayPal credit or for, I assume, something like an ACH out. But naturally, since we didn't have a PayPal or a bank account, we would just take the gift cards. And then you could spend those gift cards at like a Costco or a Target or what have you.
Wow.
But, it wasn't until 2011, maybe until 2015, where there were more like dedicated places that were open to taking Bitcoin. Looking back, I see on forums now people would like barter over Bitcoin for, I don't know, like a pizza, I guess is the famous example. But as kids, frankly, at the time, we just utilized this website. And if you grinded for enough months, you would eventually get a gift card. And Bitcoin was almost like an afterthought. I remember thinking at the time, there's no this is a cool concept, but I need to get, our credits out of Bitcoin ASAP, because it felt like almost bespoke to that website that we were using. And it definitely didn't feel like it would be relevant or exist, frankly, 5 to 10 years later.
And certainly not in the way that it does.
Yeah, I thought Bitcoin was like tied to this website. I thought it was tied to this service where you would fill out surveys rather than it being like an independent, like foundation or nonprofit or like standalone thing.
When did it dawn on you that it was something other than that?
Maybe in 2012, 2011, 2013 era. So for me, that would be towards the end of high school. Insofar as other people started talking about Bitcoin and being able to use Bitcoin on like Tor, or you'd see people reference it on Reddit or on the internet. And I saw the logo. I actually didn't even know or remember that it was called Bitcoin, but I saw the logo and I remember thinking, that like type of currency is still around. And it was used for a lot more goods and I guess exchanges. And so that's when I realized it has stuck around. It survived. Maybe it will continue to stick around and survive, but certainly not the scale that we see today. And probably not until 2016 or 15, 17 era in college, where the offshoots like Ethereum and then, leading into the whole ICO craze, where it felt even stickier. I think it crossed a material like market cap at the time. Maybe it was billions or hundreds of billions or something. And I remember also being very surprised that this thing that I'd used as a kid had grown to such scale. So yeah, I think maybe those were the two additional expansions. In high school, seeing that it was sticking around and being used for other things, not just the website I had used it for. And then in college, getting to a scale where, now we're talking, it's bigger than Spirit Airlines. It's better than like Burger King, and it really hammers in home the impact and longevity it'll probably have.
Yeah. Interesting. I mean, you were literally there, from the first moments and you effectively misunderstood it. You thought it was like a kind of point system for a website you were using.
Yep.
And the gift cards were more important than the Bitcoin.
Yeah. I don't even want to think about how much Bitcoin we ended up trading in for those gift cards. It was a grind. It really felt like a point system. And I credit again my much smarter younger brother for finding it and encouraging me to go through with farming those points. Like back then, the internet was kind of slow. Mobile was just taking off. And so, being able to quickly check like Google in order to find like the white paper, seeing the other forums, I guess like the Bitcoin forum, these were like not natural steps after just seeing this like logo for coin. And, a lot of different sites had their own form of credit system or point system. Kind of crazy in retrospect. Yeah. I wish I read the white paper in 2009 or 2010, although I'm pretty sure I wouldn't have understood it.
Yeah, I'm sure a lot of people wish that. So you created Sphere in 2022, I think it was?
Yeah, we formally incorporated the entity in 2022, and then we started working on the idea a little bit earlier that year.
What does Sphere do? Could you tell us?
Yeah, we help you move money from country A to B faster and cheaper. We are B2B. We primarily service companies that are in the software business, financial technology, and harder assets. And the root of how we are able to do it faster and cheaper is internal reconciliation of stablecoins. So as a market maker of sorts of currencies, we're able to move our own liquidity around faster and cheaper because of stablecoins versus typical correspondent banking. And so as an API and dashboard, our customers come to us, usually from their perspective, because the money that they want to pay overseas to like a vendor ends up showing up faster for less money.
So it's like faster and cheaper is the kind of pitch.
Yeah, it's like faster, cheaper, same API, same dashboard experience, but it's usually framed as like a fintech product because our customers don't need to know about the stablecoins in the middle unless they really want to.
There's kind of an invisible counting system in the background.
Yes, ma'am. Exactly.
Got it. And why did you get inspired to create the company?
I think a lot of luck. Never really wanted to be an entrepreneur. Always wanted to be a professor. And we were hacking around on blockchains for a few years at that point. My best friend Luigi and I, and we eventually came across Luna Terra. That is to say, it blew up and a lot of money left the ecosystem. And we had a realization, have we spent the last few years in vain? What is the point of this technology? And so we figured, if there is a point, a unified ledger, minimally, the first use case that is a precondition to every other use case is the movement of money. And so we figured, hey, as a hackathon project, maybe it'd be fun to just sort of capsulate all of our efforts in this industry. And maybe we get an honorable mention. It was sponsored by Stripe. And a few months later, we very unexpectedly ended up winning. And a lot of coincidences, I suppose, layer on top led us to sticking around to build the company. It eventually got incubated by a large trading firm out in Chicago. And the blessing and curse, I guess, of starting at that time is not many people stuck around. And so almost by necessity, the will to survive led to a lot more coincidences. Several years later, I guess we're almost 4 years later, it's been very interesting to play a very small role in the history of certain countries where we've been lucky to foster partnerships, work with entrepreneurs who are really incredible and unique in driving, I'll describe it as the local economic machine forward. And so what started off as a series of unfortunate coincidences, blessings / curses, has continued to, I suppose, be built. And it's in large part thanks to those entrepreneurs that we ended up becoming quite close to, both as customers and as vendors. But if you zoom out, I never wanted to start a company. And it ends up building a company can be a very good way sometimes to drive change.
For sure. I mean, if you'd become a professor, you would have presumably been reading things like the Bitcoin white paper. But that aside, starting Sphere right after the FTX collapse, it's kind of like one of the lowest trust moments in crypto. And you just described a bunch of different coincidences or serendipitous things that kind of propelled you forward or a catalyst to take the next steps, let's say. What was it that you saw then actually made you go all in, or was it not really like that? It was just more a small set of sequences as you described.
I think in the early days, it was a small set of sequences and a suspicion that there was an overreaction to what happened in industry. As an example, FTX was heavily tied to Solana. And I remember thinking, well, let's say FTX is bad. It committed fraud, it stole the customer's money, et cetera, et cetera. But the underlying technology, nothing about that has changed. When I used a Phantom wallet back then to send stablecoins from one wallet to another, it was still faster and cheaper than any correspondent bank experience or, frankly, other blockchains. And I remember thinking, maybe we're all overreacting and it's worth exploring to see if there's something here. It's very possible that no one in the world finds this useful, in which case maybe a business around it doesn't make sense. But in the event that everyone else is overreacting, this could be a good opportunity to, take a technology that's useful and focus on building around it. And going into 2023, in the months to come after FTX, it became evident that there was an underserved part of market, which has frankly blown up since, largely concentrated in places like Latin America, the Caribbean, and APAC. But as a very small company at the time, 2 people, eventually 4, we kept getting reach out from people from Brazil or from Argentina or Central America or the Caribbean. And the fact that they were interested in talking to us at all, sometimes we didn't even speak the same language, was another good smoke signal that maybe there's something here that's useful for folks. And, now that those markets have been a bit more proven out, it kind of makes sense when there aren't that many people looking in this problem area because of an overreaction to a black swan event. It means that an otherwise very successful local company might actually be willing to talk to, a team that won a hackathon sponsored by Stripe and has 2 or 4 people. And some of those original reach outs have grown quite significantly since then. But it definitely didn't feel obvious unless you were actively utilizing the technology every day. Or if you were otherwise in need of the underlying, dollar proxy accounts. And so that I call that a blessing, a curse, an instance of luck, because we were just in the right place at the right time and not overreacting, I suppose, to what was happening around us. And, maybe it's because we were kind of outsiders coming in. We had less at stake compared to an institution that had held a lot of, assets at FTX. And so maybe the burn was relatively smaller and enabled us to kind of think outside. If this large exchange goes down, how is that actually integrally related to the underlying technology or the people that could theoretically use it?
Yeah, I mean, that's like you mentioned Stripe a couple of times just now. Obviously, they do stablecoin payments, and Circle does as well. And you also just talked about like the user experience. How does what Sphere does differ from them? And then also in the back end, how does like your settlement fabric work? Like, could you like walk us through how I think you've got Sphere Pay and Sphere Net, how they work and how it differs from Circle and Stripe?
Yeah. So I realized that payments is a wide tree. It feels also similar. Certainly as someone who, 4 years ago didn't know that much about payments, it all felt like, what's the difference between the payment company that lets you swipe your card versus the one that lets you like pay an invoice with your bank account? And I would say that for most users, it should feel very similar and almost undifferentiable. When you go to a restaurant and you swipe, is it Stripe or is it Shift4? Is it Adyen that's ultimately processing your payments? I guess if the product is done well, you can't really tell. But to answer your question more directly, Stripe is a payment processor. It is a merchant acquirer. It focuses on software companies, technology companies, small to medium businesses, and it primarily helps people, swipe their cards and get paid. They do other things like treasury, other forms of payment rails, and have invested heavily into the stablecoin ecosystem. But the core business for them is being able to spin out like checkout pages. Some people call this a payment gateway type product, and they enable businesses to receive money by offering card swipe, essentially, treasury management, etc. Circle is a stablecoin issuer. So they're almost like a payments company by adjacency. That is to say, when people buy, mint, redeem their stablecoin, they can pay each other with the stablecoin. But Circle doesn't have the same setup that Stripe does, where they are a merchant acquirer or like a traditional payment service provider, PSP. And so where Stripe may be very relevant for like a Series A Silicon Valley company or a mom and pop shop that wants to take payments, Circle is more relevant for directly market makers and institutions that want to mint and redeem a lot of their stablecoin. And then downstream, retail end users who want this proxy currency account, this proxy dollar account. So their product is used for payments, but I wouldn't think of them as a more traditional payments company because they are not focused on, like B2B treasury management or, B2C merchant acquiring. Sphere is different because we are a B2B money movement platform. So our target audience is mid-market financial technology companies, trade finance companies, orienting towards larger tranche sizes. And it gets relatively complicated when you're moving hard assets between different countries because now letters of credit start to get involved, reconciliation between different bank accounts start to get involved. Those banks might not necessarily have correspondent relationships with each other. So I'd say relative to Stripe and Circle, we get a little bit closer to the core plumbing of money movement, both between banks and in and out of blockchains. We typically don't service small to medium businesses, as an example, or mom and pop shops. You wouldn't really be using Sphere if you wanted to like swipe your card and get paid as a business. You would more use Sphere if you wanted to pay vendors overseas consistently at large sizes, buy shipments of goods, fulfill invoices that typically are difficult to do so. If you are based out of an emerging market or, you have to pay in an amount that goes outside of your typical bank limit. The wire latency maybe like especially matters to you because if the wire takes 3 weeks versus 1 week, you're paying additional fees for your shipment of goods to clear it like customs. So I'd say like the target audience and the specific flavor of payments is quite different between the three companies. Interestingly, Stripe is working on Tempo, which is a payments blockchain. is working on, or rather Circle is working on Arc, which is also, I guess, kind of like an institutional payments or RWA-based blockchain. And we're working on SphereNet, which I hesitate to call a blockchain. I guess it technically is, but I would describe it as much more compliance-focused and trade-focused, where it really gets into those granular details that accelerate adoption from owners of hard assets that want to reconcile across borders. So those are those letters of credit and standby letters of credit and MT107 reconciliation. It gets like quite deep in to a very specific branch of payments that are important to us because our user base, and we posit that the user base for stablecoins is largely based in countries where they don't have easy access to dollars. And typically there's a high linear correlation between those countries and having a lot of natural resources or being hubs for import and export or other flavors of trade finance. So from a product and tech angle, we could go down the rabbit hole. But I think of Tempo as like, hey, if you're a developer on like X, maybe you're based out of San Francisco, and you want to utilize stablecoins in order to offer more competitive checkout, then I would probably think of using. I would think of using Arc if I were, I don't know, a bank or some other type of financial institution that specifically wants to use USDC. I would use SphereNet if you are an international financial institution or you are in the business of trade finance, because we give you a lot of middleware to accelerate the overall adoption required for your treasury ops team or for your compliance team. The underlying reconciliation between the three companies is pretty similar at the banking level insofar as that money comes in and money goes out. But the bank relationships that are established for those three different types of use cases are very different. Circle will lean more into their custody relationship. They technically have money transmission licenses, but that's in the absence of a stablecoin issuance license. And therefore, there's like a specific set of mandates that they have with their bank partners that facilitate minting and redemption at size. Like you could theoretically mint $1 billion worth of USDC or redeem $1 billion worth of USDC. And so it starts to lean into like repo like activities where you need to clear large amounts of obligations with the bank counterparty. In the instance of Stripe, they typically work with bank partners from the frame of a merchant acquirer. And so whether it's for like BIN sponsorship, card issuance, terminal like services, card acquiring on the internet where you like type in your credit card information and like click purchase, it means that, the money still goes in and out of the bank with Stripe typically as the merchant of record, but it's a unique relationship that focuses perhaps a little bit less on like repo type activities in comparison to a Circle. And for us, the internal reconciliation maybe is a hybrid of the two, where we are not doing merchant of record like activities. We're not spinning up FBO accounts for millions of end potential customers. We narrow our focus on a smaller set of counterparties and really laser in on supporting the edges of their use cases, because typically they're going to move larger amounts of money, touching more countries over longer periods of time. Because, say, a shipment of food from Latin America to East Asia, that's going to take time. Usually is going to be filled in a couple of buckets. And there are gotchas in between this multi-week or multi-month fulfillment as compared to, someone paying $20 for a subscription online. If interest could go into more of like the uniqueness of the liquidity reconciliation models between the three, but I'd say at like a high level, that's essentially the difference. It's three different types of or different flavors of payments.
Got it. And so like with the, could you look at like the size of the stablecoin market? I think it was like about $300 billion, and carve it up into those three boxes and say, oh, you've got this percentage of that, that's your addressable market, or is there another way of looking at it?
It's fascinating because the TAM of the stablecoin market is real time. So oftentimes our end users are only passing through stablecoins. They don't necessarily sit in stablecoins.
So there's a volume of trading activity as opposed to the issuance in the primary market of stablecoins.
Yes. Circle is probably more directly addressing a percent.
Issuance.
Yeah, because their business model is how many passive USDC is being held, generating yield for T-bills. Mm-hmm. Maybe Tempo ends up becoming more like that too, because of the relationship with Bridge, sort of like an alternative Circle. Stripe, I think broadly doesn't care about either the TAM or the volume. Maybe increasingly they will if they bake more stablecoins into their core payment flows. For us, naturally, it's a good thing if the total size of the market by way of passive stablecoins goes up.
Of course.
But the beauty of our model is we're agnostic. So like you can interact with Sphere as if you're just moving regular money. And it's almost an afterthought that stablecoins are involved for efficiency on reconciliation. But the stablecoin market could stay at its current size, frankly. And as long as the volumes go up, to your point, it implies that there's pass-through activity gaining from the efficiency of stablecoins.
So what would you say the TAM is for Sphere?
It's a good question. I could point to a number, but maybe that's less interesting. I could point to digital assets. I could point to payments or digital payments broadly. I think it's 17 trillion. I could point to B2B international payments, which I think is 30 or 40 trillion. Yes.
Yeah, of course. The TradFi that you could kind of cannibalize.
Yes, it is a convenient mental model. Although I think the closer to real answer for us is a lot of this activity is net new. It was not possible before. If a country A and country B didn't have strong correspondent relationships, that is to say their banks didn't really talk to each other that well, maybe they're both nascent markets and therefore they have to go through other banks in different countries. And it adds this layer of latency or of intermediation that would otherwise make trade really difficult. To give you a very bad analogy, this is a really bad analogy, but I think kind of describes the point well. Let's say, I don't know, a banana expires in 30 days. And so if you ship the banana, you could try to freeze them, right? You could try to refrigerate them. But for the sake of convenience, let's just say it expires in 30 days. If it takes more than 30 days for money to move at size because the correspondent relationships are not strong, then that market is not viable. It makes no sense to ship bananas from A to B. But if you can now move that money in seconds to minutes to hours to days, that's a net new market that didn't exist before. That's a net new trade quarter that didn't exist before. So it's hard for me to define the total TAM because I think the closest answer to reality is that it's still actively being built. And you can kind of cross-reference what it currently exists in terms of, call it asset movement between countries. We're probably an order of magnitude higher than what exists today because most of the world operates on USD as a reserve currency, which is gated by the availability of dollar accounts on 160 plus countries. If you can connect countries in a way that is, say, more efficient, rather than everyone having to pass through a dollar account, they pass through a proxy dollar account and can instead foster this proxy correspondent relationship between the underlying banks and two countries with each other, then it's really hard to define what the total expanse of that market looks like because now a trade relationship becomes possible between a $2 trillion emerging market and an $800 billion emerging market that was never possible before. So maybe a good theoretical floor is that 40 trill B2B, call it TAM. But I suspect that the ceiling perhaps of the net new activity that is now possible and actively being carved out is an order of magnitude higher because most of the world isn't well connected together. So many countries are just turning on in the sense of close to real time, close to low latency connectivity with others, which means that a lot of those banana-like trade activities are now physically possible for the first time.
Yeah, sorry, I've got a bit of background noise here. I think what you're saying is you've got the existing traditional finance payment market, and then you've got these new things that don't exist, and that's a little bit hard to estimate. But it's suffice to say that's very large and could be very significant in addition to the already large TradFi market that you can cannibalize.
Yeah, if the TradFi B2B money, cross-border money movement market is 40 trill, that is heavily concentrated in the G10, probably the G20. There are 60 plus other countries. A lot of them are smaller in size. A lot of them, because this new trade activity is possible, will rapidly grow larger in size. So when I say an order of magnitude higher, I suspect it's on the order of hundreds of trillions, where, maybe it's not 100 trillion today or 200 trillion today, but if new trade activity becomes possible and these markets are given 2, 4, 10 years to develop, by the time at which, you get to that scale of 40 trillion in the traditional market anyways, the expanse of activity that will become possible is immense.
Vast, yeah. Do you have competitors?
Payments is interesting. I think for specific functions, we'll have different competitors for, but like an overall one-to-one mapping competitor is hard to define. No one really does exactly what everyone else does, but everyone kind of does enough of the same thing where for specific customers or specific use cases, you will have competition. So if like a software company, as an example, wanted to on or off ramp, say in the United States for stablecoins, we'll have a lot of competitors. You could theoretically go through like a Stripe. You could theoretically go through a Circle Direct because it's a first party on ramp or off ramp from an American software company. But typically you don't go to a payment service provider for just one function. You go for multiple. So maybe you want to do both first party and third party. Maybe you want to track your invoices. Maybe you have like a specific type of customer set where the reporting rules, as an example, are bespoke to that market. You service a lot of clients in Mexico, as an example. So you're going to need to provide them documentation that makes it super easy for them to clear with their call it local bodies. If they're a regulated institution or if they're an import-export, they might need specific documentation to clear with customs. It's at that stage where I think there's quite less competition. Usually people pick a general flavor of payments. Maybe it's cards, maybe it's wires. Maybe it's like a international rail or domestic rail. And from there, it starts to segment down heavily because the complexity involved for both operations and compliance goes deep depending on the industry that you service. We are adjacent, as an example, to energy payments. But I'd say compared to a fully bespoke energy, like call it payments company for bank-to-bank transfers for the market of Southeast Asia, we're not digging into that level of granularity. So we might broadly compete with order flow with that type of company. But if we go mark to mark in Vietnam, we're not really competing with them. Vice versa, from like a high level, call it, do they sit within stablecoin land? Are they a payments company? I think for the casual third-party observer, we compete with a lot because it's kind of hard to tell what everyone does, just from like their website or from their brand. It's one of the inspirations for SphereNet. We've spent so much time these days trying to figure out what exactly a potential vendor does because the licensure, the branding, the website, it usually doesn't tell you everything that you need. And it's expensive to actually get that information. You have to like onboard, sign commercials. You have to actually go through the process of sending a transaction end to end to fully understand what their capabilities are. And so that frustration helped inspire one of the core functions of SphereNet, which is to act as a discovery engine for what specifically everyone does, because it all gets very granular. And, someone who like competes with you in 90% of cases might actually be a critical dependency for 10% of your customer base.
Interesting. Yeah, I can see how that intelligence really helps you understand what they're doing and like what services that you could provide and like how it could go wrong as well.
Yes.
What about like you just described a lot of different things and a lot of complexity. How many staff do you have to be able to get the traction that you have so far? And like how substantial is your activity at this point?
I think we have 60 or 70 people, a ballpark. And we currently process billions of dollars of volume a year. Mm-hmm. So I'd say we're not at the scale of like a Revolut or a Stripe or an AirWallex, but I'd say for the amount of time that we've been around, we've grown pretty quickly and are punching above our weight. And 60, 70 people, globally remote and roughly split between compliance, engineering, ops,
What's the focus for this year, Arnold? Is it like a geographical focus or is it like product focus?
I think I'm hesitating because some of this information is sensitive, not just to us, but to things that are happening within industry.
Cool. If you don't feel comfortable responding to that, we don't have to dive into that question.
I think it's worth mentioning that there was a cycle. These things tend to follow cycles within stablecoin land. I suspect if the last cycle was driven by players like Bridge, BVNK, Conduit, Zero Hash, maybe Zero Hash is also part of the previous cycle, which was like Prime Trust, Wire, eventually Fortress. I suspect that this upcoming cycle will be determined by a set of products that will be entering market within the next 3 to 6 months that go beyond a traditional USD, call it on and off ramp or money transmission. And I think the there's a convergence that is actively occurring between traditional payments and stablecoins. If you like zoom out, what the industry was really able to nail the last few years is a very basic example of traditional money transmission. But now that we're getting, like Genius, we have some level of regulatory clarity, the overall FI comfort level of underwriting these flows has significantly increased, and for good reason. I suspect that we're about to enter the next stage of what happens after you nail basic money transmission. And people have been talking about things like foreign exchange, about maybe card products, verticalizing payments offerings. And I believe that this makes sense if you take like a historical lens of what happened in traditional payments. But I suspect there will be a great narrative shift because those things make sense at a high level or theoretically. But when you really get into the weeds of some of these frontiers, it turns out that there are a lot of gotchas that make certain narratives very like too complex to like kind of compile down into a bite-sized statement of where order flow will go, where it will concentrate, where revenue or margin is still available. So I guess long story short, in 3 to 6 months, I suspect you will see some industry changing products that are released that expand beyond the typical orchestration use case. Knock on wood, we'll release a couple examples of these types of products, but I know that we're not the only ones for some of these markets. But it gets a little bit more complex than, add another currency, or let's put USD Euro more aggressively on chain, or let's offer more cards and underwrite it through a different, call it fin sponsor.
What would you say is like the thing that's on your mind the most for this year? Like just the things that you're thinking about. Is it just what you've described, or is there other things within the payment sort of ecosystem that's really got your attention?
I think most of the things that create noise don't really interest me. Not because I don't look at it, but because structurally, there's not much alpha left. If there's like a big announcement between a partnership between large thing and large thing, it's like, okay. If there is a product announcement, maybe it's like within agentic commerce.
Mm-hmm.
I'm like, that's like spiritually interesting, but like the data does not indicate that this is, drop everything right now. Let's stay up for the next 48 hours and build around. The most interesting pieces of industry development are the ones happening on the ground, in my opinion, where they are not in public news because the people getting this information have no incentive to publicize it at the moment. And typically it gets very deep into the mechanics of the money movement because, this is like day-to-day, week-to-week turnover in terms of new regulatory developments, in terms of new guidances across, 10, 20 plus countries, in terms of what banks are willing to underwrite, which ones are jumping into the space. Some of them are really sophisticated and releasing more product types that, go beyond money movement as well. So the things that I think are really interesting are those like, I'll describe them as like spec knowledge happening in frontier markets, because once those are properly capitalized, it's a deep tree and a hard tree to find the branches for, to find leaves for, because so much of it is local knowledge, so to speak. And it reminds me of the inner workings of different bancors or of different wire room operating principles, where it's relatively bespoke to, say, like a bank within the United States. And it's hard to find this information on the internet because it'll be part of like, sensitive trading programs that are reserved for like employees of that bank. I think we're seeing like similar analogies happening in the markets that stablecoins are most used in. And the interaction with that and the country of origin for the fiat USA is another dynamic where there's day-to-day updates. So that stuff really excites me because there are clever, participants trying to figure out how to do the plumbing properly. It's strange because, several years ago, you see a lot of these like acquisition announcements now from like large stablecoin player X and large traditional payments player. But the interesting component of those acquisitions is that a lot of what made that stablecoin orchestration player relevant enough is this lower level plumbing alpha that they were able to compile and compound over time. And so it's one of those like slowly and then all at once type vibes where the exact same thing is happening as we speak. It just won't be obvious until maybe a year or two later.
I mean, you just sort of said that you don't think like the kind of agentic world is going to enough to, drop everything and program it away. And I saw on Twitter that you'd said that agents could exploit each other in adversarial ways. How big of a systemic risk is that? And can the protocols preemptively mitigate against it, or could like the rise of this kind of create new types of flash crashes or exploits that humans can't really detect in time?
I'd say long story short, absolutely. And I think we're early enough in the adoption curve where we're not yet at the how does this get adversarially gamed out. There are some early signs of this, like NPM injections from people like publishing fake packages. That's pretty diabolical. But I think the world largely is still at the, wow, this is groundbreaking. Like so much manual labor can be automated, and people are still trying to figure out the rules of the game. As more value gets converted onto, call it automated rails, then I think adversarial games become a lot more rational for people to invest in. And I think the timeline for this can be quite compressed. As day over day, there's a new announcement of a new product that becomes possible through AI. So long story short, yes, it feels like maybe a good heuristic is the limits of what you can do with an LLM now are in how creative you are in prompting it and talking to it and giving it a spec.
Yes.
And so I think in math terms, like the total, if you just think of it as a function, and right now we're still trying to figure out what the domain is, what that domain maps to is almost certainly going to be a larger space. The range is going to be larger than the domain. So, you can take AI as a form of efficiency leverage in many places, and it is very difficult to map out every edge case. And so from first principles, it stands to reason that there will be many more edge cases or areas of exploitation because a creative enough person can try to figure out an edge case that was not originally prompted. And if you tell the AI, hey, like, make sure this thing makes no mistakes, it will almost certainly have like a vector for making mistakes, versus if you spend 10 hours really drilling down to try and find a way to force it to make a mistake. And so I think the tweet that you're referencing, I was specifically referring to like on-chain activity. It'd be difficult for an AI at any meaningful level of complexity to create a perfect smart contract because it's a wide space. A lot of things could go wrong at sufficient complexity. And yet, as we increasingly use AI workflows to deploy these increasingly complex smart contracts, you just need a bad enough actor who spends enough time to figure out an exploit that will take down, so to speak, that contract. I don't know if that's possible to enforce going away for permissionless environments. It's like DDoS, right? Like how do you prevent DDoS? Because it's the same principle. It's so much more efficient in generating spam or bad traffic than it is in preemptively trying to figure out what form factor is that coming you into. And so for the last 30 or whatever years of internet history, we've just resolved that you have to blacklist it. You can use like algorithms to like predictively blacklist. There are ways to make it more efficient in blacklisting, but like fundamentally it comes down to a rejection of the source of that traffic. I suspect that AI will go down a similar path where whitelists and blacklists in effectively get enforced for blockchain stuff at the protocol or network level. And then for the broader internet, I'm very curious to see what happens when there's like a sufficiently large black swan and what sort of controls or oversight become required at that point. Because the time that we have to come up with a very nuanced and perfect solution on oversight is definitely not long enough compared to the amount of activity that is being developed in general usage expansion or exploitation.
Yeah, no question. Like apart from these AI risks, what would you say are the biggest other systemic risks in the stablecoin ecosystem that people aren't paying enough attention to?
It reminds me of like how there's like that test where you give a child a cookie and you say, hey, you can either have one cookie now or you can have 2 cookies in 15 minutes. Or you ask a human to imagine like 1 billion pencils. It's like biologically impossible to compute, to visualize literally 1 billion pencils in their head. You can imagine a lot of pencils, but 1 billion is crazy. I suspect that the tension is the world's reserve currency makes sense to distribute in high areas of need in the world. And it makes sense locally, short term, for the US to find additional buyers of its debt. on the margins through these proxy currency accounts and underlying T-bills. But history is rife with examples where if you over-concentrate a dependency on a single nation state, it ends up becoming a lot of systemic risk because now there are many foster children, so to speak, to take care of. And so I sometimes wonder if it's outside of like biological compute for humans because it makes sense in the short to medium term. Structurally, it's almost like our systems have to operate this way, where it's like quarter over quarter, year over year progress. But on a slightly longer, and it's not even that long of a time horizon, maybe it's like 2 years, 4 years, 5 years, 10 years. I wonder if this ends up becoming quite bad because of overconcentration risk. The more concrete form of this is increasingly markets that are not the United States are realizing that if they adopt a variation of genius, this leads to local citizenry. We're very rationally choosing to hold assets in this proxy dollar account. It's almost like a vampire attack on local currency. And it makes sense, again, for many markets, but it gets a little bit more nuanced when you're looking at like G30 or something, or G50. These are like robust enough markets where they are, in the upper percentages of global commerce. It is marginally better for local citizenry to be able to use USD, but the policies that the Fed recommends are designed. Their mandate is for America, and so it's difficult to imagine someone that doesn't really like live in Lagos to like properly determine monetary policy for Lagos. And yet, in the current direction that we're headed, in effect, not only does Fed policy have a disproportionate effect on what happens in Lagos, but if the majority of citizenry are using dollar-denominated stablecoins for daily activity, now that dependency is near 100%, and it materially reduces the ability of the local sovereign to conduct monetary policy. Now they're just stuck with fiscal policy, which makes them even more dependent on the United States. So I think that will be one big area of systemic risk. If the stablecoin market really does expand, where does liquidity concentrate to? And how does this affect the material ability of the local sovereigns to maintain their self-sovereignty? And I worry about the second and third order consequences of that. And there are many canaries in the coal mines right now, the most frontier markets for stablecoins. If I were to point to a second area of systemic risk, it would be the velocity of all this happening. Mm-hmm. Permissionless environments don't have circuit breakers, which we're already at like sufficient scale where this is starting to become concerning. But once we start approaching the scale of like M1 or M2 or like the supply of money, then the lack of circuit breakers could lead to liquidity injections and exits, maybe ejections that are harmful, not because, it's like fundamentally bad flow, but the violence of the transition is almost necessary because so much money is coming in and leaving at the same time so quickly. And if something goes wrong, then, it's very hard to tell what becomes rational behavior thereafter. Without circuit breakers, as an example, it's like rational to like accelerate a bank run, right? There's no like downside if you withdraw from a given counterparty, if you suspect there could be a bank run. And so it almost becomes like a self-fulfilling prophecy.
Definitely, like a Mexican standoff. I mean, a similar thing happened even with like Deepwater Horizon with all the banks that were lending to BP. Because if one pulled the facilities that they got, everyone was going to lose out. And it required a decision for them all to stay in the game to keep the company afloat. And there are many examples of that. Would you say that the euro dollar is in any way a proxy dollar account and presents similar systemic risk that you've just alluded to, Arnold?
It's fascinating because it's almost like a catch-22 where I'd say European Union, maybe it's due to composition or history, or I'm sure it's a bunch of factors. The outset of rules are more intense, which necessarily limits the total adoption and thus scale. And so it's primed to be a proxy currency account as well, especially for flows that don't want to go through explicit dollars. But yet it is self-contained enough where the total scale of it, at least today, is somewhat limited, where there's enough friction in its usage that it's not yet at like the, call it $1 trillion mark or hundreds of billions of dollar mark, rapidly growing into the next order of magnitude. I guess time will tell, at least from the order flow that we see. I don't think it will be the biggest risk vector. It remains to be seen whether that type of situation is the one that you want as like a sovereign versus having a much more aggressively adopted local, currency account in form of stablecoin. That maybe like grows to size too quickly, and then you insert the circuit breakers later, versus like preempting it all, but then limiting total adoption. Yes.
Gotcha. What's the song you're enjoying most to listen to at the moment?
Oh, that's a great question. Well, usually I don't listen to songs, although when I was younger, I usually like the sound of silence. But when I was younger, I liked jazz and Chopin a lot. So maybe I'll listen to one of those today.
Do you still use gift cards?
I do not, regrettably. I should see if that website still exists, although it sounded like such a scam back then. It was like freeonlinesurveys.com or something. Yeah. Would have to dig through the original iPhone, see if it still has the internet search history.
Wow. Yeah, I mean, maybe you want to read the Bitcoin white paper before that.
Yes, ma'am. This time I'll be prepared.
Excellent. It's been a real pleasure to have you on Unblocked. Thank you so much, Arnold, and best of luck with Sphere. Look forward to chatting with you again soon.
Thank you very much for having me on, and appreciate a very fun conversation. Looking forward to being back.
That was Arnold Lee on why stablecoins win as payments infrastructure and why the builders who asked the hard questions in 2022 are the ones writing the rules now. If this one made you think differently about stablecoins and where Web3 is heading, share it. See you next time on Unblocked.